On October 22, 2025, the world's largest gold ETF surged to a 3-year high, while the gold inside it became legally unreachable. That wasn't a glitch, it was a revelation, because on that same day, Bloomberg reported that Japan's largest gold ETF traded at a record 3.2% premium to its net asset value, the widest gap since 2014. Arbitrageurs, the market's natural stabilizers, didn't step in to buy the cheap ETF shares and redeem them for physical gold. They couldn't, not because the gold wasn't there, not because the vaults were full or the bars unallocated, but because the title rights attached to those bars weren't portable across jurisdictions. That premium wasn't a sign of irrational exuberance. It was evidence of a broken contract. And the Volatility Index tracking gold ETFs, GVZCLS, confirmed it. On April 1, 2026, it spiked to 32.7. The highest reading since the 2008 financial crisis. But this wasn't price volatility. This was legal volatility. The market pricing in the growing risk that an ETF share, backed by real gold in a real vault, might not deliver enforceable title when it mattered most. Reuters documented the same fracture amid the Iran conflict earlier that quarter. ETF inflows surged, but physical delivery channels froze under sanctions. Demand exploded. Title enforcement collapsed. The gold sat untouched in London vaults. But for US and Japanese investors, it was legally unreachable. This is the paradox that broke the wrapper. Record ETF demand coinciding not with deeper liquidity, but with rising legal friction. Not less gold, less access, not weaker confidence in the metal, but weakening confidence in the legal infrastructure meant to represent it. Gold ETFs don't just hold gold. They wrap it in layers of trust law, custody agreements, and cross-border enforceability. And when those layers collide, when New York trust law meets English bailment law meets Tokyo securities regulation, the wrapper doesn't just stretch. It snaps. So what we're seeing isn't volatility in price. It's volatility in asterisk claim. Not a failure of gold, but a failure of the legal fiction that lets us treat it as globally fungible. This wasn't a market anomaly. It was the first visible crack, and to see where it runs, we have to trace the gold and the law, step by step. So we saw the crack. Now let's follow the fault line down, to the bedrock of legal architecture. The world's largest gold ETF, SPDR Gold Shares, known as GLD, isn't just a ticker symbol. It's a legal stack, and at its core lies a deliberate, high-stakes contradiction. Its prospectus states, plainly, asterisk, title to the gold bullion held by the trust passes to the trust under New York law. That's not boilerplate. It's the foundation of the entire structure. Investors buy shares in a New York-based trust. Their claim is governed by New York trust law, familiar, predictable, enforceable in U.S. courts. But here's where the chain bends. The actual gold, the 400-ounce London Good delivery bars, doesn't sit in New York. It sits in vaults in London, held by HSBC and JP Morgan, under English bailment law. Bailment law is fundamentally different. It doesn't confer ownership. It creates a custodial relationship asterisk. The vault holds the gold for the trustee, but the trustee doesn't own it outright. They hold it in trust, subject to English jurisdiction. So GLD's structure rests on a contractual bridge. New York trust law governs the investor's claim. English bailment law governs the physical gold. The bridge holds, until stress reveals its seams. Because when push comes to shove, U.S. courts can't compel a London vault to release bars governed by English law. And English courts won't enforce a New York trust deed over assets physically located and legally defined on their soil. That's not a flaw, it's the design. Now look east. China's 5/1 ETF doesn't even attempt that bridge. It holds gold bars minted and stored in Shanghai, under the direct custody rules of the People's Bank of China. No LBMA certification. No cross-border redemption path. No recognition by U.S. courts. Its title is native, rooted entirely in PBOC regulations and Chinese securities law. It's not less legitimate, it's asterisk incompatible. You can't arbitrage between GLD and 5/1 ETF. Not because the gold differs, but because the legal title does. One is portable in theory, the other asterisk by design. And that brings us to the most important sentence you'll hear in this episode. Quoted directly from goldsilver.com's 2026 Deep Dive. Asterisk. ETFs deliver exposure, not ownership. When stress hits, the difference between held for you and held by you becomes legally decisive. That distinction isn't academic. It's the boundary between liquidity and lockdown, between a paper claim and a bar you can lift. GLD doesn't fail because the gold vanishes. It strains because the title chain snaps at the border, where New York ends and London begins. Where trust law meets bailment law. Where enforceability dissolves into jurisdictional static. This isn't about bad actors or sloppy contracts. It's about physics. Gold is physical. Law is local. And when you wrap one in the other across borders, you don't get global liquidity. You get a jurisdictional contract, with an expiration date written in case law, not code. So if the title chain snaps at the border, what happens when sanctions slam that border shut? So Chapter 2 showed us how the title chain bends New York trust law, London bailment law, Shanghai PBOC rules, all held together by contract, not physics. Chapter 3 shows what happens when that contract hits a wall no clause anticipated. In March 2026, OFAC designated a major London-based custodian, the very institution holding gold for multiple US-listed gold ETFs. The gold didn't vanish. It wasn't moved. It wasn't even touched. But overnight, US ETF holders stopped receiving physical redemptions. Instead, they received no action letters, formal acknowledgments that their redemption requests were being held in abeyance. Not denied, not delayed, legally suspended. Their title still existed on paper, but it couldn't be enforced across the sanction barrier. Kitco's March 2026 Iran conflict report captured the immediate fallout. ETF inflows surged, but vault audits slowed 40% in London. Why? Because verifying title requires cooperation between custodians, trustees, and auditors, cooperation severed by sanctions. No audit, no verified chain of title, no redemption path. That's not a liquidity crunch. That's illegal quarantine. As Sprott Research put it plainly, liquidity stress emerges not from lack of gold, but from inability to legally transfer title across sanction regimes. The bars sat intact in their vaults. But for US holders, they became legally unreachable not because the metal was missing, but because the law governing access had been severed at the border. This wasn't a glitch in the system. It was the system working exactly as written, revealing, in real time, that gold's global liquidity is bounded not by supply or demand, but by the irreconcilable legal standards governing ownership across jurisdictions. That legal quarantine didn't freeze the market. It rewired it. Because when US ETF holders received no action letters, instead of gold bars, central banks and exchanges didn't wait for Washington to lift sanctions, or for London vaults to reopen their ledgers. They began building parallel systems, where title isn't imported, negotiated, or adjudicated across borders. It's born, verified, and enforced within one sovereign legal regime. Take Dubai's new gold settlement hub, launched in February 2026. It doesn't trade LBMA bars. It trades coins minted by Dubai's own mint, stamped with sovereign insignia, and stored in vaults audited exclusively under UAE federal law. Why? Because title is native, not imported. When you hold one of those coins, the chain of ownership begins and ends under Emirati jurisdiction. No New York trust deed. No English bailment agreement. No cross-border enforcement risk. Just a single, sovereign, enforceable claim. That's not isolation, it's optimization. And it's scaling fast. Reuters reported in April 2026 that central bank gold buying surged 22% in Q1, but 78% of those purchases went to domestically audited vaults, not London or New York. Not as storage, as sovereign title anchors. These aren't holdings waiting for redemption. They're assets embedded in national financial infrastructure, with title verified, enforceable, and insulated from foreign court orders. This isn't about avoiding dollars. It's about avoiding US courts. Because the constraint isn't currency, it's adjudication. Gold's new settlement layer isn't physical. It's legal sovereignty. And it's already live. Tokyo's JGB-linked gold repo facility uses domestically certified bars. Shanghai's gold futures exchange requires PBOC-verified title for margin. Even India's new bullion corridor mandates RBI-approved custody for settlement. The result? Three increasingly distinct gold markets, not because the metal differs, but because the legal right to compel its transfer does. Price divergence isn't noise. It's the market pricing and enforceability risk. Where title is portable, liquidity is deep. Where it's sovereign, liquidity is certain. Gold isn't being replaced. It's being re-architected, bar by bar, law by law, court by court. No longer a hide under your mattress asset. As Bloomberg put it, it's now infrastructure. Legally fragmented, jurisdictionally precise, and adjudicated locally.